Right, let's look at an example of the RSI then. This is a chart, of course, of Marks and Spencer's. Each bar represents one day, so that's the daily bar chart. This is the relative strength index here, as you can see, a single line. As you can also see, quite a bit volatile, going up and down all over the place. That's why it's the third one that I look at. I look at the MACD first, the stochastic, and then the RSI. I usually even devote the least space to it on a price chart. As you'll see going forward, you'll look at my default chart. And also for other professional institutions, when I look at the research reports from the big banks, you'll often see the RSI there, but they are cagey about how it's used. Because, as you can see here, okay, how do we know that that wasn't a crossover from an oversold territory and we didn't get a buy signal at that point? What might it have been with my wobbly line? Might have been this. Okay, went down for a couple of days, only to shoot up again. Did we get a better signal there? Well, yep, we certainly did, you betcha. We got a great signal, but we wouldn't have got it at this point, of course, because it was still rising. It was only at this point, the next day, that we would have seen, and therefore, the day after that, we could actually have entered. Now, we might have entered at the open and gone short, or chances are we would have gone short below the previous day's low, so we would have gone short at that point there, and would have been okay, only to see a bit of a rise and then a bit of a plummet later on. The point is, yeah, it goes down, seems to go sideways, doesn't give me good signals. What does it mean when this happens? Was I supposed to exit at that point? Or what? Now, in other words, it's got several weaknesses, which we have to take care of by using our other indicators. Equally, we have to take care of those weaknesses by using money management skills. If we're going short a stock, maybe using that as an entry point, i.e. the previous day's low as an entry point, so we get in whenever the price falls below that level, we have to say, well, where's our stop loss? Is our stop loss, say, that point there, the opening point on that day, on the basis that the market shouldn't hit that if we're right, and then as we move lower, we move the stop loss down and down as well to capture and lock in some of those profits. That's one way we avoid some of these mistakes which we might otherwise have in indecision. But equally, the most important way is we overlay the stochastic and the MACD, as I'll show you later on, into this to avoid making classic mistakes related to the RSI as well. All I wanted to do in this chapter, therefore, was to show you the RSI, show you some of the problems we have with it, in that it can give rise to this choppiness, can be difficult to interpret, but it has its uses. And the uses are, as the tertiary indicator we look at, so the first two, the MACD and the stochastic, as this being the third one we look at, it can often confirm what we're looking at elsewhere. It just adds a little bit of weight if we see a positive divergence or a bearish divergence on this as well. But in and of itself, it is not going to give us signals we want to buy off. It is too difficult to interpret to only look at this and say, oh yes, this is falling, therefore I should sell. This is rising, therefore I should buy, and so forth. Now you could argue, well, wait a minute, if I looked at this and I entered just as it entered above there and sold whenever it crossed below this line, so at that point there, for instance, I would have made quite a good return. Whoops. There. Got out and got in here. And similarly, if I had sold there, and then I don't get in until don't get out until it gets there, I would have made a good return on the way back. And the answer to that question is, yep, guess what? That's perfectly fine on this example. Unfortunately, there aren't enough of these examples to justify doing exactly that. It becomes too difficult, too choppy to apply that systematically time and time again. But, if you can find, and that's what trading's about, if you can find a variation on that rule, it may well work for you. It may work indeed. But as things stand, this is one where that rule, that simple rule, there and there would work, but there are too many where it won't. That's why we avoid it. In this instance, what we do get instead are better buy and sell signals when we're looking at and capturing these momentum trends. We get better buy and sell signals when we overlay the stochastic and the MACD as well.